Right. So earlier, particular example was given. Price of the unit is given. Price and the quantity 20 and 800 respectively. We can calculate the total revenue if we multiply quantity and the price. 1 unit 20, 800 unit cents, just we multiply. So then we calculate like 16,000 as total revenue. As well as the firm has to spend 2,000 for raw material, 1,000 for wages, 400 electricity, and 500 to settle the interest payment for loan obtained. Then in here 16,000 is counted. Then the total cost means combination of all these four, 3,900. Accounting profit 16,000 minus 3,900. Then answer is 12,100. As well as in economy, opportunity cost is considered as the production cost. The opportunity cost is referred to as the real cost or the economic cost. Both direct as well as indirect cost is considered under the economic cost. So the economic cost sense direct cost plus indirect cost. Then the profit means total revenue should be subtracted. I mean the total cost say should be subtracted from the total revenue. You are given an example once again. Details relation to the cost of a firm given below. Output 1,000 units, unit price 50. So the direct cost 2,000, purchasing raw materials 4,000, expenses on fuel 1,000, economic depreciation 400, wages foregone 1,000, a normal profit 2,000, interest income foregone 200. So then what we realize at last, economic depreciation, what does this one represent? Particular value which is foregone. Simply economic depreciation, earlier I cut such a value. Simply we can replace here interest foregone, interest foregone, or as rent foregone. Then wages foregone is there, normal profit, interest income foregone. So the total revenue 50,000, just multiply 1,000 into 50. Direct cost, combine all the things together, plus indirect cost. Then economic profit is 39,400. What did we consider? Only both direct and indirect cost. If we look at accountant accountant profit, so total revenue minus direct cost. So the total revenue 50,000. Direct cost, it is 7,000 only. Then the 43,000 is the accountant profit. So then this is the difference between accountant profit and economist profit or economic profit. So economic profit is lower than the accountant because of indirect cost involved in the production of uh, economic cost. Right. After that, we do concern the short run production function. So short run production function and the long run production function should be discussed separately. I taught you short run, period where only variable factors are increased in order to increase the production. But in the long run, both fixed and variable factors are increased. In other words, all inputs are increased in order to increase the production. So far, in the long run, we can't classify resources into fixed and variable. The thing is, all the resources are likely to be variable in the long run. First of all, we do concern short run production. In the short run production, you know, variable factors are increased like labor. So labor is increased while capital is held constant. I mean fixed factor. I told you a particular example. If a grocery shop, imagine entrepreneur just set up a grocery shop. He has a building, two vehicles, a number of refrigerators, this and that, as capital. But as the business started, you know, number of workers can be increased while the process is launched. But immediately the entrepreneur or the owner may not increase number of number of refrigerators or else buildings as well as vehicles. That's why in the short run, fixed factors like capital are held constant. Only labor are increased in order to increase the production. Anyways, the production function in the short run is determined, or else the pattern or the nature of the production function depends on the law of diminishing marginal returns. The law of diminishing marginal returns. This is a theory, but we should learn. Based on the theory, we consider the pattern of output or the impact on the output when there are changes in number of variable factors. So in the short run, only variable factors are changed, then the production depends upon the law of diminishing marginal returns. Right. So it says the short run in a production process is a time period within which amount of certain factor input, at least one factor input used in production cannot be changed. Simply capital. Therefore, in the short run, both fixed and variable inputs are used in the production. Given the constant technology and the capacity in a factory when the amount of variable input is changed, how the final output changes, the technical relationship between factor inputs and The final output is explained through the short-run production function. So you are given production function, labor, variable factor, K, fixed factor, capital, as only variable input can be changed. In the short run, the above given function can further be explained as below. Simply, quantity depends upon number of labor. It can be changed from L1, L2, L3 to Ln. Number of labor are increased, but capital only one. That is the meaning of this equation. If there is a question in your paper, define short-run production function. You should explain what I told you before or what is involved in the material. So what we have to, after that, you have to say number of variable factors are changed, but capital is said to be constant. Then you should draw up, you should mention this equation. If not, you can use another method. It says here down Q equal F, quantity of output depends upon variable factor V1, V2, V3, and Vn, number of variable factors, but only one capital, right? So this is how we realize short-run production, actually short-run production function. After this, long-run production function. So I told you that in the long run, production function actually determined by both variable and fixed factors. Therefore, no more classification like that. So all the inputs are considered in order to make number of output. It is called long run production function. So it says in the time necessary to convert fixed production into variable factor is considered as long run production of a firm. In fact, in the long run, all the factor inputs become variable inputs, and there are no fixed factor inputs in the long run when the amount of all factors inputs necessary in production process are changed. How the output changes, or in other words, in other words, the relationship between input and the output is explained through the long run production function. Now, production function is given. If you compare with the first one over here, number of labor is changed, but capital was constant. Right now, capital even changed. Number of capital even increased with the increase in labor. This is how we illustrate long run production function. Simply input output relationship or technical relationship is analyzed by or analyzed through long run production function. The production process can be divided into two stages: the short run production process, long run production process. So what we have done, short run. Now we explain once again further number of things included in the short run production function or process. In here, we have to discuss special concepts. You know, we should know number of, we should be able to define both fixed and variable cost, as well as particular diagrams regarding short-run production process. And we have to consider the theory, the law of diminishing marginal returns in the short-run production function. Right. It says the firm that engage in the production of an item in the short run utilize both the fixed factor inputs and variable factor inputs. In the short run, the production firms add increasing quantities of variable factor like labor and to the fixed factor input like capital, and there is a certain fixed pattern in how the final output changes when increasing quantities of variable factor is added to a fixed factor by production firms in the short run. Right. So it says here the concepts of production cost in the short run. And one more important thing, whenever you have a doubt, you can raise your voice. It is open to you. Any matters regarding the lesson or any previous things, of course, you have a right to ask any question. Right. And the next one, if you want to ask anything from the WhatsApp even, please put your stuffs to the our group. Sometimes I don't, if you ask something, I can understand. I mean, I don't know the student, this and that. Therefore, better if you ask anything through the WhatsApp group. Next one, what you ask, the question would be a question for you, as well as it's a similar matter to all the students in this class. Therefore, you should, it's very, I will appreciate if you have any things regarding this and that. It's okay. Right, we'll start once again. But one more thing I won't tell you, don't be, after the completion of the syllabus, we may not have time to do once again the theory. Therefore, don't be recalled, spend time unnecessarily. Then and there you have to complete. If you have any problem, ask right now. It is the very important way. Right. So next one, concept of production cost in the short run. Both fixed and variable factor inputs are used in the short run production process. This is a total fixed cost, total variable cost of production. The summation of the above mentioned two cost items is referred to as total cost of production in the short run. The undermentioned cost concepts too could be found in the short run production. So number of concepts should be studied in here. First of all, we have to know what is fixed cost, what is variable cost, as well as total cost. Thereafter, we will look at average fixed cost, average variable cost, average total cost, and marginal cost. So simply, you may consider total 7, number of concepts, total fixed cost. Next one, total variable cost. And total cost. So total fixed cost means the cost on fixed resources that does not vary with the level of output. Fixed cost means the cost on fixed resources that does not vary with the level of output. And variable cost means the cost on variable resources that does vary with the level of output. So the total cost means combination of total fixed cost and total variable cost. So total fixed cost may include number of cost items, rent, insurance, fixed cost. But variable cost may include wages, cost of raw materials, this and that. Then the total cost means combination of these two. Right now, we may consider average fixed cost. Average fixed cost. Average fixed cost sense fixed cost per unit produced, average. We take the total fixed cost and divided by number of output produced. Then we can count average value. So average fixed cost, AFC, abbreviation. The fixed cost per unit of output is defined as the average fixed cost. The average fixed cost can be obtained by dividing the total fixed cost by the total output. So average fixed cost sense total fixed cost, what I mentioned here, first point, and divided by quantity that the firm produced. It is called average fixed cost. We knew that fixed cost is constant, but number of units are increased gradually. Then what will happen to the average fixed cost? It will diminish gradually. Average fixed cost decreases gradually like this. Just I draw up a diagram and show you. Average fixed cost started somewhere here, thereafter fixed cost decreased as number of units are produced, then but it does not touch the quantity axis. As number of units are increased, necessarily average value should fall. So even though that average fixed cost declines as output increases, it never becomes zero. Therefore, it takes the shape of rectangular hyperbola. So cost, decide quantity. Actually, what does last sentence mean? It doesn't touch the quantity axis. Necessarily, there is a fixed cost. Therefore, whatever the quantity it produces, we can't expect zero average fixed cost or negative value. It won't happen. That is the meaning. Anyways, there is a fixed cost in the production. After this, average variable cost. So the average variable cost means variable cost per unit produced. Variable cost per unit produced. Earlier I mentioned the second point, total variable cost. Simply cost on variable resources that does vary with the level of output. When many units are being produced, average total variable cost increases. Right now, average variable cost per unit produced. In here, total variable cost divided by number of output produced. Simply, when the total variable cost is divided by the output, average variable cost decreases up to some extent, thereafter it will rise. Therefore, average variable cost curve is U-shaped. Vertical axis should be labeled as cost, and the horizontal axis should be labeled as quantity. Here the uh, average variable cost. You see, there is a place where a minimum point, right? From here to say 0 to that place, quantity, here 0, up there, when number of units are supplied up to here, average variable cost decreased. Thereafter, average variable cost increased. You see, such a pattern is considered under the average variable cost. Actually, we can we can name this as U shape. It is average variable cost is U shape, as well as the shape of the curve is determined by the law of diminishing marginal returns. Law of diminishing marginal returns. Then there are two aspects of law of diminishing marginal returns. One is increasing returns. Other one is decreasing returns, diminishing returns. Here, increasing returns. Other side, diminishing returns. So I just put one here and second one. So in the very first period, increasing returns, average cost decreases as number of units are supplied. After that, second period will take place, diminishing returns. Then the average cost increases. That's the reason why the curve is U-shaped. So average variable cost per unit of production is defined as the average variable cost. It can be derived by dividing the total variable cost from the total output. The average variable cost curve takes the shape of English letter U. So the average variable cost equal total variable cost divided by output. TVC divided by quantity. This is how we calculate average variable cost. And the next, average cost. Average cost. In other words, average total cost. Sometimes AC, average cost. Sometimes ATC. So average cost means total cost per unit produced. Then the total cost is counted, then divided by number of unit produced. You see, we calculate total cost divided by quantity, TC divided by Q. If not, we can use another formula, AC, average cost equal AFC plus ABC. Simply combination of average fixed cost, average variable cost, what we discussed short while ago, can be added together to calculate average cost. So the total cost per unit of output is defined as average total cost. It can be derived by dividing total cost by the output, total output. As the output increases, the average total cost declines until a certain point, and then it starts rising. Therefore, the average total cost curve to takes shape of English letter U. So same diagram what I drew before. Same thing, shape. Instead of ABC, right now we will label as AC. That is the only difference. But we should know the meaning of average cost and the way of calculating average cost. Right. So after that, we do concentrate. Marginal cost. The next one. So marginal cost means the additional cost when additional unit is produced. The term margin represent always additional. When the production exists, when the production increases by one unit, there is an increase in total cost. So it is considered here as marginal cost. Then we calculate the marginal cost by considering the change in total cost divided by the change in output. So the additional cost of producing one more unit of an output is referred to as marginal cost. This can be derived by dividing change in the total change in total cost from change in output. So marginal cost MC abbreviation, change in total cost divided by change in output, delta TC, delta means change divided by delta Q. Later on, you are given here a diagram. Earlier I drew average cost, average variable cost, average fixed cost. Right now, all the diagrams are drawn together. Uh, so average cost curve, say average fixed cost, it slopes downward continuously as number of units are produced. Here the average variable cost, average total cost, and here the marginal cost curve, what we discussed right now. It goes to the lowest point of these two, and it is even sort of U-shape, Right. So this is the area what we considered today about cost of production, especially in the short run, number of definitions, including the way of calculating each and every concept. Right. So we do the balance of this in the next week as usual.